Welcome to the Real Talk Real Estate Podcast PDX. Our mission is to give real value to home buyers and sellers, shed light on the home buying and selling process, and give insight about the market and suburbs of Portland, Oregon. I'm your host, Dylan Thomas, licensed principal broker with HomeSmart Realty Group. Although this podcast is centered around home buyers and sellers, Real Talk Real Estate is for anyone looking for home tips and market updates in the Portland metro area. Thanks for tuning in and enjoy the show. Hey, what's up, everybody? Welcome to the Real Talk Real Estate Podcast. I'm your host, Dylan Thomas, licensed principal broker in the state of Oregon with HomeSmart Realty Group. Today, I have Travis Smith in here with me. He has 6.5 years of lending experience. We're going to dive deep into different types of loan programs. And he was born and raised in Oregon, and looking forward to what he has to say. This is all in line with educating buyers and sellers with the different types of programs available and what the pros and cons may be to them. So thanks for coming today, Travis.
Thanks, Dylan. I appreciate you having me here. I'm with Cross Country Mortgage, and I've been in the industry, like Dylan said, for 6.5 years. And I just wanted to come on here. Dylan asked me to come on as a mortgage loan officer here and talk about the exciting world of mortgages. So I would give I'll be happy to give some information on all the different loan programs out there, and we'll go from there.
Cool. So I know I worked at a bank for a little while as a banker. I did lines of credits and stuff, and we've bought 4 houses, me and my wife together.
Oh wow, nice.
So I know quite a bit about the different options out there. Obviously, I've never been able to use like a VA loan. I've actually never used a FHA loan. My first one was USDA, which was
nice,
awesome.
One of my favorites.
I kind of wish I would have known about down payment assistance programs at that time.
Yeah.
I don't think I would have bought as rural as I did.
Yeah.
I think there's more appreciation to be had in town, but regardless, USDA is an awesome program. And then our last two have been conventional loans. So let's kick it off with that. Let's talk about conventional loans and what kind of requirements there are for that. I think.
So first of all, I'd like to say you're definitely not alone on that. A lot of people aren't aware there are down payment assistance programs out there, USDA financing, VA financing. VA loans are actually the best mortgage out there. If you're a veteran, active, or veteran or in the reserves, it's the best program available. It provides 100% financing, and one of the big benefits is there's no mortgage insurance. The rates are going to be lower than conventional loans. They're very forgiving when it comes to credit scores. Some lenders will have overlays requiring 620 or more, but they actually will go down to 580. And it's just the best loan out there. So it's I'm happy for that because I appreciate all the people who serve for our country. But that's my favorite loan program. USDA loans are another one that's rarely used. Most people don't know much about them, and we can chat on that in a little bit later. And then, of course, there's the conventional and FHA. So for those of you who are new to the mortgage world, or trying to think about buying a house and don't know really what options are available, there's really 3 categories of loans. You have your conventional financing, which is more just your traditional mortgage. There's government loans, which would be FHA, USDA, and VA, which we'll cover in a little more depth. And then there's jumbo, also called non-conforming. So jumbo loans are loans that exceed the conforming loan limit, which varies by county, but for the most part, it's $484,350. That's in our area, and that's pretty broad.
And that's for the loan value, correct?
Yes. So anything exceeding that would be called a jumbo. So you can purchase
higher than that.
Correct.
As long as you put enough down to get below that, then you stay.
Correct.
Okay.
Correct. So the loan amount cannot exceed $484,350, and that's for most counties there. So I just want to kind of cover that basis first. Anything under $484,350 qualifies for what we were talking about a moment ago, called the conventional financing. And conventional has all sorts of different loans under it you can use. There's some specialty loans in there. There's renovation loans. But the traditional conventional loan is typically you see people putting 5% or more down. And there are 3% down programs with conventional. A couple of them require you to be a first-time home buyers. They're either going to have income restrictions or certain restrictions to allow you to use 3% down on that. But that's a great program that a lot of people don't know about. I still can't tell you how often I run into people thinking they need 20% down to buy a house, when really, that's more of avoiding mortgage insurance. 3% down is an option, as we discussed and will discuss. 100% financing options, grant programs are available.
Okay.
So down payment's one of those things I run into a lot. Conventional. The big thing about conventional loans is they are very credit score sensitive. So with an FHA loan, it has fixed mortgage insurance, and it has an interest rate that's far more forgiving on a borrower's credit score.
Real quick, let me interject here. Mortgage insurance. What exactly is mortgage insurance for those who don't know? Because it is on conventional, and it is on FHA, it is on USDA.
Correct.
And it's on conventional unless you put 20% down, correct?
Correct.
Okay.
Correct.
So what is that?
And it's a great question. Most people ask about mortgage insurance, and we think insurance, like when you have your homeowner's insurance or your car insurance, it's insuring you against costs and liabilities. Funny thing about in the home ownership world and the mortgage world is the mortgage insurance does not actually protect you. What that is they came out with mortgage insurance as a way to insure themselves against offering higher risk loans. So it used to be back a long time ago that the 20% down rule that everybody still seems to have stuck in their head applied. And they wanted to figure out a way to make home ownership more affordable to people. So they wanted to open up options on putting less money down. As you put less money down on a house, that obviously makes it a more risky loan. Sure. When you're lending on something, if you have less value depth between the loan you give and the value, then it's a higher risk loan. So as a way to offset that, they came out with something called mortgage insurance. And what mortgage insurance does is it insures the lender on their loan. It does not insure the borrower. So it's a way to offset the cost on borrowers who default on their mortgage. You're paying mortgage insurance into a form of an escrow account that then is used to help subsidize lenders who have mortgages that are defaulted on.
Gotcha.
So it does not protect the borrower at all, and that's why most borrowers everybody hates paying mortgage insurance.
Everybody hates it.
Yes.
I hate it.
Yeah, I do too. And I pay mortgage insurance. Can't wait till it comes off.
I know. I'm trying to get my appraisal done this next year too.
Yes.
Get it kicked off.
Yes. And speaking of that, that's one of the great things about conventional loans. The two most common ones you see are conventional and FHA. And the big thing that a lot of people talk about is the mortgage insurance. And as you were just mentioning, one of the big pros to conventional loans is their mortgage insurance is not for the life of the loan. So it's going to vary that premium you pay on it depending on how much you put down. The more you put down, so if you put 3%, 5%, 10%, 15%, the more you're putting down, the lower your mortgage insurance is going to be. And the beautiful thing about it is when it gets to 78% loan to value, your house does, it automatically drops off. And if it gets to 80%, you can write in and show proof of value, and your loan servicer will drop it off for you. Some of them have a 2-year requirement on that, but it depends servicer to servicer. So that's one of the big benefits of conventional loans is the mortgage insurance is not for the life of the loan.
Okay.
And on FHA loans, the mortgage insurance is for the life of the loan. So it doesn't matter if you get down to 20% loan to value, you're still paying that mortgage insurance.
So unless you refinance or sell the house, you're stuck with it.
Correct. You're paying it for as long as you're in there. And one more note on mortgage insurance, which is very rarely communicated well, is that FHA loans have something called upfront mortgage insurance. So not only are you paying a monthly mortgage insurance, when you buy the house, they do a 1.75% upfront mortgage insurance that is financed on top of your loan. So if you have a $100,000 loan, there's going to be a $1,750 upfront mortgage insurance cost that's added on top of your loan.
Now, is that so? There's down payment, there's closing costs. Is the upfront mortgage insurance, is that included in closing costs? Do you have to bring that to close, or is that just stacked on the loan?
No, it's just stacked on the loan. So,
Gotcha.
So it's nothing you pay for. You can pay for it out of pocket, but most people that are going FHA, there's a reason for that. Typically, they're looking for the lower down payment option, or their credit scores are lower, so they tend not to have the money to pay it up front. Not that I would advise them to anyways, but you can. But I've in 400 transactions.
Sure.
I don't know how many FHAs they've been, but I've never had somebody pay it up front.
Yeah. Okay.
But that's it's a very one of the cons of FHA, which we'll get into a little bit more down the road.
Okay.
And I kind of find it a little bit easier to compare the two rather than just run off all the stats on each one. But mortgage insurance. Nobody likes mortgage insurance. It's not fun, but you have to consider the fact that it's a way to allow you to buy it if you don't have 20% down, and I appreciate that. I'm willing to pay that cost in order to obtain
the lender's
my house.
taking all the risk.
Yeah.
If you decide not to pay, and you default on your loan, anybody can decide not to pay.
Yes, correct. And you're borrowing hundreds of thousands of dollars. Lender wants to make sure that they have
I don't like it, but I understand it.
Correct. Yeah. And on that note, I was just having a conversation with a colleague about it, which is kind of an interesting concept. Is back to the whole. A lot of people think that they have to have 20% down to buy a house, which is just a myth out there. That us being in the industry, we kind of forget how how little it's always communicated out there. Until you're looking for a house, you typically don't know much about mortgages.
There's a huge lack of education.
Yeah, most people don't even know there's a T in the word, when they're saying that. And so one of the big things on that is, some people hate the idea of mortgage insurance. They, whether they know or not, they decide, all right, I'm going to save up 20% to put down to avoid that mortgage insurance. When really, you want to consider, an appreciating market, especially like we have been. And, historically, I look at housing as being very appreciating market. But the amount of money, the amount of time it takes you to save up that 20% could be time spent in an appreciating market, which would get you to that no mortgage insurance faster. Right. So although it may make sense to be like, I don't quite have 20% down yet, let me wait another year and, tuck everything away to buy. If in that year you have a 5% appreciation rate, that's all money that you're buying that much more of a house, which makes your down payment that much further away, which slows you from avoiding this mortgage insurance.
I love that you're bringing that up. And I totally would love to go down that rabbit hole and talk about all that stuff, but let's save that for another episode.
Yes.
That goes, I would like to do a full episode with you on, the cost of waiting.
Yeah.
And, talk about investing.
I'd love to do that. I'm a big fan of that.
I don't think there's any better way to invest your money.
I do not.
I still have my retirement accounts.
Yeah.
But real estate is the number one investment tool, in my opinion.
Yes. And long-term especially.
Oh, yeah.
Long-term. Yeah, I'm happy we can sit down again and have another conversation regarding just the benefits and even financial advantages of owning real estate.
Perfect.
So, back to conventional mortgages. Again, on that one, the big thing is it's credit score sensitive. And if you have, there's so many different guidelines that are ever changing in it that, you can go through a whole list of all the different income and requirements for conventionals. But in an ever changing world of mortgages where they're updated sometimes daily, you really want to reach out to a mortgage professional to get the ins and outs of it.
So what I guess with the conventional, so you said, minimum 3%.
Yes.
And then once you get above the 5 and plus up to 20 and beyond that, the mortgage insurance goes down. Maybe does that affect rate, how much you're putting down?
Yeah, and that's actually very interesting. And I just want to mention again that the conventional 3% down loans, those have restrictions on them. Once you're at 5%, as long as you're buying a primary residence, you can, or a second home, that's open to anybody to do that. You can have multiple conventional loans at that point.
Gotcha.
You're not going to get multiple 3% conventional loans. So a lot of people, if you ask them, even lenders will kind of think 5% down when they think conventional, but there are some 3% down options. When you're talking about interest rates, it's kind of interesting with conventional loans. As you would logically make sense, the more you put down, the lower your interest rate would be.
And higher credit score as well?
And higher credit score, correct. But there's interesting little nuance to that. And when you're putting 5% and 10% and 15% down, once you're seeing that increase, once you go to 20% down, interest rates actually are a little bit, not dramatically, but a little bit higher than if you were to put 15% down.
That's interesting.
Yes, and the reason for that is back to that mortgage insurance. So the lenders are actually safer with a borrower putting 15% down with mortgage insurance than they are a borrower putting 20% down with no mortgage insurance. So it's counterintuitive to think you're like, okay, I'm putting 20% down, I should, and it's not, again, it's not dramatic, you know, maybe 4.65 to 4.5 or something like that. Very, very small change, but it's always funny when they're like, well, what's my interest rate go to when I put another 5% down? You're like, it goes up. It's like, well, and then it continues. You see it's a trend back down, you know, as you go. And then once you put over 40% down, there's really no change. So, you know, it goes, they go down the more you put up. And once you've put 40% down, they consider that to be a very low risk loan. And you don't really see any more perks on your interest rates.
Gotcha. Okay.
And I mean, is there any more, any other specific questions regarding conventional financing?
I guess, so debt to income ratios, what's standard for conventional loans?
It's a great question. So that's another thing that separates out the loan programs is debt to income ratios, which you'll commonly hear referred to as DTI.
Sure.
And so there's a front end and a back end, and the back end is the key one. And when I say back end, what they're looking at is your housing payment plus all other debts. So auto loans, credit cards, student loans, whatever the monthly payment reporting in your credit report is for those, plus your mortgage payment is what they view as your monthly debts. And they don't want your monthly debts to exceed 45% is the general rule of thumb for conventional of your income. So for example, if you make $10,000 a month, they don't want your mortgage payment and all other debts to exceed $4,500 a month. And that's a general rule of thumb for conventional. They've tweaked around that a little bit, but pretty much that's where you're capped at. You know, you've seen approvals a little higher than that. It used to be a little bit more flexible on that, but that's pretty much the general rule of thumb you'll find on that. Whereas,
and is that consistent no matter the down payment?
That is correct. Yes.
Okay.
Yes.
And that's calculated back end. So all your debt, so your monthly payments, your auto loans, your credit cards, your student loans too?
Yep.
Yes?
Yep.
So those added up.
Child support, if you had child support, that doesn't report in your credit report. But
they include that.
And we will find out about it. You know, it's important. Sometimes there's things like that we pull your credit.
You guys dive deep.
You have
after
to.
After the full
you
blown,
have to. They want to know the full picture. You know, any spousal support, alimony, any fees like that or costs. And, you know, sometimes you even see something that's crazy.
And the opposite way too, right? If you are receiving.
Correct. That counts as income.
Okay.
Yes. Yeah. You got to use that. And, you know, one of the income things, not to go off in the weeds too much, which is kind of interesting, but since we're on child support, is they look at not only how much income you make, but they really look at the likelihood of continuance. So one thing I've run into on numerous occasions is a borrower who, let's say they have, they receive child support from their ex, and then they go, okay, so I receive $1,000 a month in child support. Now they're going to look at making sure that that's going to continue for at least 3 years. So if your kids are 16 and 17, we cannot use that income because once they turn 18, you stop receiving it, you won't have that anymore.
Gotcha.
So that's just something most people, when they're kind of running the numbers themselves, I mean, it's really important to talk to a loan officer who's going to go through and explain all that stuff to you. But when you're at home kind of calculating out what you think your finances are, it's not always what it appears. I mean, income could be a whole podcast on itself. Another huge one I feel kind of obligated to mention is with self-employed borrowers, even as real estate agents would be. You know, there's so many times that they're telling me how they make, you know, $250,000 a year. And so they, you know, think, oh, I don't need to, you know, submit my tax returns. I just want to go put an offer in on a house. You know, I make so much money, and then they end up submitting your tax returns, and you see they net $50,000 a year.
Right.
And that's what we're reporting to the federal government. That's what we are obligated to use. And then they always kind of give me the wink and the look. You know, I'm writing off all the tax. I write off all my expenses I can think of, and you know, to avoid paying taxes. Yeah. Like, I see that, and you're not alone. A lot of people do that. I understand that, but you can't tell the government that you only bring home $50,000, but tell us, oh, I actually bring home $200,000. Yeah. It doesn't work like that. You know, government regulated companies. You know, we're not reporting stuff like that, but we have to obviously go off the what's reporting on the tax returns. So when you're a self-employed Self-employed, you definitely want to talk to a loan officer, and you definitely don't want to wait until you think, oh, if I'm going to buy next year, then I'll just go talk to him next year. You want to get ahead of the ball and make sure you understand those little things that most people don't think about, because we have to use your net income, and
at least get educated on it.
Yes.
I mean, if you're not buying for a year, maybe it's not necessary to run the credit report and all that, but at least get the financials in line.
Yeah, the earlier you do it, the better, because we'll set you on a path where you know exactly what you need to do.
I don't want to dive into
this.
I
know. The mortgage world, that's what I was saying when you asked me to come on here. It can get real deep.
Yeah, for self-employed, with your income, so correct me if I'm wrong, once you are ready to buy, say you were writing off all your expenses, everything you could, and you were claiming, you were netting your $50,000, and that's what you were paying the government on.
Yeah.
You're getting ready to buy a house, so you decide not to write off all the stuff that you were, and now you're netting 100.
Yeah.
Now you guys can only, do you average the two?
So we're going to use a 2-year average. We have to use a 2-year average. So that's why you really have to have your ducks in a row with that. Yeah. And of course you should always, write off expenses appropriately.
Yes.
When you're
we're
buying,
not CPAs here.
Yes, exactly. And I have to say, with taxes, I cannot legally say any of that. You have to talk to your CPA about it. But yes, so we have to use your 2-year average, and that's another thing that hangs people up. They think, okay, I'll just, really cut down on my expenses 1 year so my income spikes, and that's not how it works. And then one more quick note on that is if your 2-year average is declining, we have to use your most recent. Because remember, this as the investor, they want to know what to expect the income of this borrower they're lending money to is making. So if they made $100,000 in 2017 and then $80,000 in 2018, unless you can put together a really good picture and a letter and probably a note from your accountant explaining why that happened. I took 3 months off. I was extremely ill. Some kind of scenario that would explain why that decreased. We have to go with the lesser of the two.
Sure. Yeah.
So that's important. Yeah. And like I said, we could do a whole podcast on income. But that's, another thing that is just something to keep in mind when you're getting ready to buy a house.
Okay. So 3% minimum down payment.
Correct.
And then you can put as much down as you want beyond that.
Correct.
Match loan value of roughly $484,000 in this area. Debt to income's capped about 45%.
Correct.
And then what's the minimum credit score for conventional loans?
So the minimum credit score is typically you're going to see it in the 620 to 640 range.
Okay.
And companies will have different regulations and rules on that.
So each company is a little bit different.
Yeah, okay. and the whole thing is you run all these numbers when you get all the data, depending on income, credit score, down payment, property type, all these factors go in, and what they do is look at a layered risk scenario. So they might bend more in one area if you're stronger in other areas. If you have a lot of reserves, putting a lot of money down, they might be a little more flexible on debt to income ratio, might be a little more flexible on credit score. Basically what it is, analyze you as a full picture and then assess whether or not it's an approvable loan. So with credit score, although it does go down to 620 and 640, unless you're putting a substantial amount down, you definitely want to avoid mortgage insurance, because if you can even get mortgage insurance, because another thing on conventional loans is the mortgage insurance is through private companies. There's 6 or so different private mortgage insurance companies that all will offer it. FHA's is a government, so it's not like you go shop around for what mortgage insurance rate's the best. But when you're 620, 640 with conventional, it's hard if, I don't even know if you could with under 20% down, because you'd have to get mortgage insurance to say okay on it as well. But on top of that, your rate's just going to be awful. So it's pretty rare to do that unless people are putting substantial down. I have done them before, but it's very rare. Typically, kind of the 700 mark is when I start. There are exceptions, of course, but the 700 mark, once you're over 700, conventional kind of opens up as more of an option.
Okay.
In most cases, like I said, there's one-offs in different scenarios for everything.
Sure.
Under 700, you're looking more FHA, USDA, VA if you're qualified for them.
Okay. So good segue then into the FHA. So the minimum down payment there is 3.5%.
3.5%, correct.
And you can put above that.
Correct.
So is there any advantage? I guess if you're below a 700 credit score, what is the advantage to FHA? Say you do have that 5% down. What are you looking at with FHA?
So the advantage to FHA, again, typically if you have more money to put down, the only time you're going with FHA is when you have a lower credit score. and then debt to income ratio. And then also all of these loans have a little bit different rules and regulations as far to how far out of bankruptcy, foreclosure, things like that, which pretty much can change. So I didn't bring those exact guidelines for each different chapter of bankruptcy or anything like that, but they all have a little different rules. So there's always scenarios that might guide you towards one or another. But the big reason why, if you did have more than 3.5% down, you'd go FHA, is having a lower credit score. Back to the mortgage insurance here is, as I was saying, FHA's mortgage insurance is through the government, and they charge a single monthly premium, regardless if you have a 620 credit score or 800 credit score. It's going to be a 0.85% premium. Whereas conventional, they're going to judge you on your credit score. If you're a 640, it's going to be a lot higher. If you're going to have, an 800, it's going to be significantly lower. So if you have lower credit, one of the benefits is mortgage insurance is a lot cheaper. The monthly mortgage insurance is on FHA. The interest rates are also far more forgiving on credit score as well. And then back to our conversation on debt to income, FHA, I mean, I've done them up to 55% back end. Whereas conventional, as we mentioned, was more of a 45%. So they're more forgiving in your debt to income ratio as well. So sometimes if you're somebody with a lot more debts and you still want to buy at this certain purchase price and you need to qualify for a higher mortgage, the FHA will be your only option.
Gotcha. Okay. Well, that's interesting to know. Now, does credit score affect rate in FHA loans as it does in conventional loans?
It has an effect, but not nearly as dramatic of an effect on it. And with FHA, too, a lot of people will ask, what's the lowest there? And it's kind of an interesting scenario because FHA will actually technically take you down to a 500 credit score. It'll allow you to qualify.
Oh, wow.
But anything under 580 is going to require more interest or more down payment. You won't be able to do the 3.5% down if you got a 500 credit score. You're going to be looking at more like a 10% down. So although it's an option, it is, maybe your only option, but you're not going to be able to get that 3.5% down. And then also you're going to feel it in the interest rate for sure. So, I typically tell people you really, 580 is, bare minimum. Again, there's this one-off. So you're getting a gift, getting a gift from a relative or, you came to some inheritance or something and you really want to buy a house, you're lower. There are options. There's, typically if we can make it make sense, you have enough down payment, there's options. There's always options available.
Okay.
But 580 is kind of where I typically say is where you want to be for most FHA loans, and once you're over that, you can at least do the 3.5% down.
So minimum 580 with 580 credit score with FHA, minimum in the 620 to 640 range with conventional. But it may make more sense to go FHA than if they're going to have a better rate on that end and potentially lower PMI depending on how much you're putting down.
Correct.
Mortgage insurance.
Correct. And I actually thought if we have time that I can kind of show you a little sample scenario here, just run through some rough numbers that might make it a little easier to understand. I know the mortgage jargon can be a little overwhelming the first time you hear it. But also on FHA, as far as a con that I think is not communicated very well, I think I may have mentioned this, is that upfront mortgage insurance.
Yes.
So with the mortgage insurance, although you may look at it and say, hey, my mortgage insurance is cheaper with FHA because it's fixed at that 0.85%, whereas, conventional might be over 1% depending on my credit score. Conventional loans don't have any upfront mortgage insurance. FHA loans have upfront mortgage insurance. And what that is an additional form of mortgage insurance that's financed into your loan. I believe, we went over that a little bit earlier, but that's a key thing that people don't think about too much when they're looking at FHA loans.
Okay. And so I think we've covered pretty much everything with the FHA. Minimum 3.5% down. Debt to income up to 55% with some exceptions, possibly. Minimum credit score 580 with some exceptions, possibly. And the upfront mortgage insurance and then the fixed mortgage insurance for the life of the loan. Rolling on to USDA.
1 second there. I just want to point out one more thing that just kind of hit my mind about FHA loans is a lot of times people consider these to be first-time homebuyer loans. They're often referred to as that, which they are. And there's an important little something to think about with that, because you don't have to be a first-time homebuyer. You just cannot have another FHA loan at the time. And there are actually scenarios where you can if you're buying far enough away from your current one. But for the most part, you cannot have two FHA loans at once. So you don't have to be a first-time home buyer. You could sell your house right now and go get an FHA loan on another house. That would be completely fine to do. If you had an FHA loan right now, you could not convert it to a rental and go use an FHA loan on another house. So that's
Could I take my conventional house, rent it out, and go purchase with FHA?
That is tricky, and that's that. I don't know if the guidelines would actually allow that. You would probably have to have a pretty good justification for why you were doing that. I actually don't know. I've never had somebody try to do that.
That just crossed my mind. I was like, light bulb went on.
Actually, I do know. If you have an FHA loan, one of the things is FHA loans, even on like a duplex, still low down payment. Down payment, I should mention back for conventional. If you're buying a duplex or a 3-unit or a 4-unit property, you have to put more down to do that. FHA is more forgiving on that, and they don't make you increase your down payment. You can still use that 3.5% down. So it's not uncommon to see somebody go get a multi-unit with an FHA loan, and then after that, convert all that, use as a primary residence where they're living in one unit, renting out the other two. And that's a great option for people who are, they're worried about their monthly payment.
Sure.
One way to bring it down, to, under $1,000, because I have people ask me about that. And I'm like, well, you're not buying in Portland unless you have a lot of down payment if you want your mortgage under $1,000.
Right.
But if you go move into a multi-unit where you can rent out the other 2 units and you occupy as one, not only does the rental income from those other 2 units help you qualify for the higher loan because they're going to be more expensive, but then you can go buy a new primary residence after you have some equity in that. If you're in it for a year or so, you can go buy a new primary residence and rent out your other 3-unit property. So that's something that's very common. You can definitely do that.
I didn't know that. Yeah, that's good to know. So you can buy a duplex, triplex, fourplex with a FHA loan and not have to put that 20% down.
Correct. And that's a reason people with higher credit scores use FHA financing
Gotcha. Okay.
as well. But that's where it gets weird when you're, can't buy it as an investment property. You have to be moving into it.
Yeah.
So if you have your own, like I own my own primary residence, I'm not going to go buy a triplex with an FHA loan.
And how long do they require you to live there? Is it a year or is it 2 or?
It's, that's an interesting.
Because you signed something, right?
Yeah.
In the closing docs.
Yeah. So when you're signing your closing docs, it's interesting because you're signing something that says I intend to occupy this as my primary residence for at least 12 months.
Okay.
So 12 months is what I tell people you're looking at to honor it. Now, I have had people go earlier, and that's typically in a scenario where they have kids on the way, they need a bigger house, they have a awful neighbor, a good reason to where they thought this, or they have a job relocation.
Okay.
So you're not necessarily going to be crucified if you don't stay in it as your primary residence, but really a year is what you're looking at. You're signing something saying, but the verbiage in there is you intend on it. So your intentions of owning as a primary residence. If something comes up, like I said, example like that, awful
just
neighbors,
keep making your payment.
Move away. Yes, you can do it earlier.
Cool.
Again, with these programs, there's so many different little things we could talk about. It would probably be pretty extremely boring for a borrower. And with ever-changing guidelines, those ones I mentioned tend to stay pretty firm. But the rest of that is something really on a case-by-case scenario to dive into. The big ones are looking at income, credit score, down payment, debt to income ratio. Conventional and FHA, neither of those have income limits, or does VA does not have income restrictions either. But moving on to USDA loans, that is a loan for people buying in rural areas. And there's a map online you can go to typing USDA eligible areas, and it will kind of show you a map of it. Obviously, Portland proper, you're not going to get a USDA loan. Right. I personally live out in Estacada. I wasn't able to qualify for a USDA loan, but my house would have been. Mm-hmm. USDA, they have income restrictions, so that's kind of they don't because it's a 100% financing program, and they're not trying to put that out just for anybody. They were trying to help people, farmers, rural areas, people who tend to make a little bit less income, still be able to buy a house out there. Right. So there are 100% financing options, and they also have loan amount limits as well. So where FHA and conventional, they're going to be up higher. I should mention FHA's loan limits. They do vary by county and number of units, but in the Portland area, they're up at $474 and $950 if you're buying in Portland. Those adjust, as they look at the cost of living. We've seen them go up over the last several years.
I didn't know they were that high now.
Yeah.
I mean, just a few years ago, I feel like they were low 400s.
Yeah. And even before that, they were down, I think it was like 385 or something. I know conventional used to be 424. They've been moving up as we've seen house prices appreciate. They move up.
Well, that's good because it's getting harder.
Yeah. USDA, theirs also have been moving up, but they move at a very slow pace, as you might see.
Snail's pace.
Yes. The government at work there.
What are they looking at for loan limits for USDA now?
So that one varies pretty broadly. Their income and their loan limits vary by county, far more so than conventional and FHA do.
Okay.
For Clackamas County, where I live, it's $379,960. So if
you can still get a nice house.
Yeah, definitely. Yeah. And as you go rural, you see the prices being lower and lower.
Yeah.
You can't buy a farm or anything like that. It's got to be a residential property. It can't be a high income producing property or anything like that. But you get the 100% financing, and then the income restrictions are also they change, and they go up as we see housing go up and wages go up. But it depends on the county, and also depends on your household size, and that's a really big thing to look at with USDA. Is when they qualify you, we look at your household income when you want a USDA loan. If you come to me for a conventional or an FHA or a VA loan, you show me you can buy it by yourself, and we look at your pay stubs, your W-2s, we determine your income, and that's all that matters. With USDA, they look at your household income, so they would need to know what your wife made. What if you had a buddy who was going to be living there with you, they'd need to know what he made, and they cap their income restriction on household income. And for a 1 to 4 person family, it's around 86,000 on the low end, and then like Clackamas County goes up to 101,000. If you get 5 or more people in the house, it goes up more. But yeah, so that's a big thing with USDA to consider.
As far as people in the houses, that I'm assuming that includes minors.
Yes.
Okay.
Yes.
So
as far as the household
got 3
size,
kids,
yep.
Then that's going to bump you up a little bit.
Yeah. Parents with 3 kids is going to put you into the 5 person category.
Okay.
Which I think at that point goes up to 125,000 or so in Clackamas. Don't quote me on that. But another big thing on USDA loans, they're actually kind of tricky right now because they have a couple things. Not only is the loan limit capped and the income capped, but they're back to the debt to income ratios. They are the strictest with debt to income ratios.
Right.
They have a back end of 41%, which if you remember, conventional was 45, and FHA you're looking at closer to 55. And USDA also has a front end of 29%. And I hadn't explained that yet, but your front end is purely just your mortgage payment. So it ignores all credit cards, auto loans, and everything. So
what percent was that again?
29%. 29. And it's very, there are scenarios where you can go a little over on those if you have enough what they call compensating factors, other strong parts, extremely high credit score, reserves, so a lot of money in the bank. They look at your overall profile and they'll have a little wiggle room, but they're by far the strictest on that.
Okay.
So that one really handicaps people because your income restrictions, you can't make a ton of money, but then also your debt to income ratios are tighter too. So it's harder. You have to be kind of at the sweet spot where you're flirting with right at the max income limit, and then also have low debts in order to really hit the sweet spot for USDA. There's a lot of options out there. I do them all the time, but it's definitely one of the trickier programs to qualify for. A lot of lenders won't touch them. One of the downsides of them is that not only do we have to underwrite them, but the government, USDA, underwrites them. So our underwriters look at it, review it all, and then prior to closing, we have to send it in, and it's another set of underwriters going through that might ask for conditions. So they're trickier loans to do, but they're great loans. 100% financing, great interest rates, and the mortgage insurance, which we can chat about in a minute on those, is far better than FHA.
Yeah. When I bought my first house as USDA, as I mentioned, when I bought it, my front end was fine. My back end was a little bit higher, but because of my credit score, I was able to qualify for an exception. Is that still in existence? Okay.
Yeah. So the
back end's more forgiving. The front end that's pretty much set in stone unless you have a lot of money, right?
Yeah. And in my experience, over the years, I believe you. What year were you doing? Did you do your USDA?
Oh man, 2013.
2013. Yeah. So. I've seen them get, I think actually it used to actually formerly be 43% on the back end, but
And it was a slow process.
Yes, and it is. I usually want a few extra days on that, just because it's always rough when it goes out of your hands into, the government's got to do it. And, sometimes all of a sudden I was doing them when the government shut down. When the government shut down, you can't do USDA loans. Their government, they're like, nope, not going to do anything. And they got backlogged for a while. They were understaffed, and it was when the market was crazy. I mean, they might say it could take 3 weeks to get your underwriting decision back, and God forbid you had some conditions in there. So there was, right now it's been pretty smooth and everything's good, but you can get into contract and the government comes out and says they have budget issues and they're shutting down. You're not getting a USDA loan. So there's some things that's a pretty rare scenario, but I've unfortunately experienced it. And it's just a slower process. So that's one of the things, it takes a little bit longer to close. Conventional and FHA, the general rule of thumb is 30 days. We can definitely close them, and a lot of lenders out there can close them in far less. Legally, I think it's 10 days is the shortest you could close them because they have disclosure wait periods when you're buying a house. But as a general, industry standard, 30 days is what you run into the most.
Okay.
And that's typically, you can, like I said, close them a lot faster, but you just want to cushion yourself to be safe on that.
So I think back when I bought it was like a 45-day or maybe even a 60. I don't.
With USDA, it's one of those things. Yeah, it's sped up for sure. I still say you can do it in 30 because I don't want the borrower to lose out on or miss out on getting a house. It's just one of those things that you got to communicate up front and just make sure everybody understands that there's parts that are out of your hand. So 30 days is completely realistic if we're on top of it and we're getting things done, which you always want to do as fast as possible. Shouldn't be an issue at all. But if for some reason there's some government issue holding things up, it's really out of everybody's control. And then, another thing is, which depends how rural you're going, but when you're ordering an appraisal, if you're out in the middle of nowhere, sometimes it can take a lot longer to get an appraisal back. So there's some considerations that unfortunately you don't know until you get going into it. When you order that appraisal, you can just go off past experience and, kind of what you're seeing in the market. But when someone's buying, 5 hours out in the middle of nowhere, there's not a lot of appraisers jump into that. And they might say, it's going to be 3 weeks till we get it back to you. Then you're like, okay, well, then we have to have it underwritten, then go to USDA for them to underwrite them. So that 30 days gets a little bit tighter. But that being said, in a perfect world, you'd want 40 days on it. But 30 days is still, what I feel
still doable.
Doing. Yeah,
cool.
For sure.
And that's along the lines with the other loans as well.
Correct.
So, cool.
And then on USDA loans, their minimum credit score technically is 580. I don't know of any lenders that'll do them under 640. I don't know if that's just all company overlays, but typically they're looking at 640 on that. And then the mortgage insurance on those, they have their own version of an upfront mortgage insurance, similar to what I said FHA has and then conventional does not have. But theirs is called a guarantee fee. But whereas FHA's is 1.75%, USDA is only 1%. So it's cheaper there. And then their monthly mortgage insurance premium is 0.35%, whereas if you recall, FHA's is 0.85. So it's a great loan. I mean,
so quite a bit less per month on the mortgage insurance.
Less upfront and less
upfront.
Yeah.
Cool.
And it's one of my favorite loans. Honestly, maybe it's just because I live out in Estacada, so it's a very an option out there for a lot of people.
Sherwood's still on it.
Sherwood is
parts of Wilsonville.
Parts of Sherwood as well. Or maybe it's all Sherwood. But I
remember
years ago they were talking about.
I don't know if it's.
They were talking about expanding, expanding the areas of where it's not eligible, but they haven't made that move yet. And Sherwood is still, believe it or not, parts of it. Not that you're going to find it, a house that you can buy at that, in that loan amount with your income and debt to income ratio. It's pretty tricky to do. I doubt they're doing many out in Sherwood. I've never done a USDA in Sherwood.
Newburgh is on it.
Newburgh is, yes.
McMinnville?
Yeah,
no, not McMinnville, right? Too populated?
So it's interesting. There's little parts, I believe, and I'd have to pull up the map, but I believe downtown McMinnville might actually be one of those areas. And, just like you'll see certain areas where, like Eugene, everywhere as far as you can go around Eugene is USDA eligible, but in Eugene proper, there's a little area in there it's not. So, when you say rural
Dundee,
outside of Portland,
Dallas,
yeah.
Hopping over, I don't know if Forest Grove is still on there.
Yeah.
Okay, Forest Grove. North Plains.
Yep.
Banks.
Yep.
So, quite a few. St. Helens.
Yep.
Scappoose.
Yep.
Quite a few close in areas that will work for people and zero down.
Damascus, Troutdale, just outside of Oregon City areas for sure.
Canby
for sure, yeah. Canby, Mall, all that. So it's one of those. It's a great program.
One of my favorite little towns is Hubbard.
Hubbard.
I think Hubbard's going to boom.
Yeah. Yeah.
It's right off the highway.
Yeah. I don't know why.
Wilsonville's already pretty populated, and Canby's gotten real hot.
Definitely.
Woodburn's getting hot. So I think little old Hubbard's next.
Yeah, there it is. Buy your investment property. Yeah. I love it.
I love the USDA loans. I think it's a great option if you can qualify for it. I know it's a little bit more stringent.
Yeah. And their interest rates, you'll find tend to be a little bit lower than conventional loans as well. Again, they are credit score sensitive, not as extreme as conventional is, but overall, FHA, USDA, and VA you'll tend to find have lower interest rates than conventional loans do. And so USDA, it's one of those things. You can use them on manufactured homes, which is a whole nother world you can talk about. But there's a lot of little details on all these loans that we could talk about for days. But USDA is a great program.
We could do a whole episode on manufactured homes.
Oh yeah.
And the loans around those.
Yeah,
that'd be cool.
Yeah,
cool.
And then the final kind of one that's while we're still in the conforming loans, which are those conventionals and the governments, is that VA, which I was telling you about. And
so another potentially zero down. I mean, it is zero down.
Yep.
As long as you qualify, which is active and
reserves as well.
Cool.
Yeah. And that one, it literally is the best loan as far as pricing. There's no mortgage insurance, no upfront mortgage insurance, and rates are great. It's a program that is
no mortgage insurance at all on that one.
Nope. Yeah. It's a highly deserved loan.
What are the rates like?
It's the best one. They're going to be closer to FHAs. So, like right now, again, there's variables in it, but there'll be mid threes, I would say.
Okay. And so are the guidelines pretty much the same as FHA as far as credit score and DTIs go?
VA is one of those unique ones where they are the least strict in the majority of areas as far as credit score. I mean, I guess they don't they go down to 580. A lot of lenders will require 620 on that. But for instance, debt to income ratio is not really a thing with VA. They don't get strict. You can go 65 back end. They have something called residual income, which is
I don't think that's a good idea.
Yeah, it's kind of interesting. So they go a different route about it. Yeah, it's very interesting.
And there's no mortgage insurance on these.
Yes, and they're really gray area on a lot of their guidelines. But yeah, they look at something called residual income, which they have a calculation that shows with all your costs involved, depending on your household size and everything, you have to have this much excess income, and they have a whole calculation for determining that. But they are far more flexible on things like debt to income ratio.
Yeah.
They
so I just want to mention, and to the listeners, I really would not recommend maxing out your buying power.
No.
FHA with over 50% DTI, that means over half of your income is going towards the house, and that's pre-tax dollars. Don't stretch yourself that far. And if VA lets you go that high, I don't think that's a good idea.
Yeah.
So just be mindful of that. Add up your pre-tax income, and then kind of go based off of that. Try to stick around conventional loan limits, that's why they are conventional loans, and conforming loans is they stick around that 45%, which is, I think that's a comfortable mortgage payment.
Definitely. And it's a case-by-case scenario. And, when I talk to borrowers, just because you can qualify for a certain price point and a certain mortgage payment doesn't mean you should,
Sure.
You should know your finances, better. We can help you and kind of analyze stuff. But if you're living paycheck to paycheck, needing to use a down payment assistance program, borrow some money from a family member or something, or I shouldn't say borrow, get a gift from a family member. You cannot borrow. You can get a gift from a family member to buy a house, and you shouldn't really look at moving up from a $1,200 rent payment to a $2,000 mortgage.
Right.
There's tax advantages. You can claim more on your W-4, so you get a little more out of your paychecks because you're getting some tax, on the mortgage interest write-off and property taxes. So it's not always an apples-to-apples comparison, but also if if your washer goes out, it's not like somebody's going to come fix it for you.
Right.
You got to do that. So you also want to, consider things like that. Obviously, the biggest thing in mortgages is, in my opinion, that they're a great tool because, everybody uses leveraging to attain what they want. Big companies, it's beautiful to not have to buy something out in cash. but you don't want to over leverage yourself. That's where you get hurt when, as in the 2008 crisis, you saw everybody was over leveraging themselves, making minimum wage and getting huge mortgages,
Right.
knowing that, worst case scenario, I'll refinance my loan or sell my house. And when you get in that scenario and too many people do that, we saw what happens there. So just because you qualify for a $2,000 a month payment doesn't mean that you should do that. You really need to sit there and assess what your comfort level is, and your lender will help you figure that out. But you're really going to be the one who knows that.
Yeah. Yep. But yeah, VA it's a great program for military vets and active military. I've had a few clients, not too many, use it. I'd like to find more to work with in that program, just because it's such you get a stellar interest rate, no mortgage insurance at all, and 100% financing, which it doesn't get much better than that.
No. Yeah, the majority of people you see is conventional and FHA. And, that there's a lot of lenders out there who really steer clear of USDA because of the complexities of it. And VA loans, sometimes they just don't know that much about them. But VA loans, you got to be a veteran. So obviously you're not going to, depending if you live down in San Diego where there's a huge military base and things like that, you might see more of them. But for me, I come across them, but it's not, I don't work with them. Majority of people I work with are not veterans. So you automatically can assume that's not going to be the loan to go for them. And if you're not going rural, then you can pretty much assume USDA's out. So that leaves a conventional and FHA, which are definitely the most commonly used ones, for sure.
Cool. Well, I think you brought a lot of value to us, Travis, and I appreciate your time in explaining all these different rules and regulations with the different loan types. We're definitely going to have to get back in here and dive deeper on some of these and, talk about investing, talk about manufactured homes.
Yeah.
So I think that's a hugely misunderstood market when it comes to loans and loan eligibility.
Yeah.
I did a little bit of work over in Central Oregon.
Mm-hmm.
So I know more than the average realtor around here.
Yeah.
Because there's a ton of manufactured homes there.
Oh, yeah.
But especially your affordable houses out there, the majority are manufactured homes and they're on an acre plus.
Yeah. I've done many loans on those. And
a common thinking around here is you can't use FHA.
Yeah, it's not true.
You can.
Yeah.
So, there's just so many. There's so many.
Double wide has to be built after 1976. Can't have been moved more than from the factory to the land. Got to have tie downs. Interest rates are a little higher, but it's people kind of aren't aware of it, that it's still definitely an option out there for you.
Mm-hmm.
But I appreciate you letting me come on here and chat about this. I know it's not exciting to sit there and learn about all the mortgage guidelines. And again, you can go on for days and days about it, but it's something that unfortunately,
it's extremely insightful though.
Well, all the time. So hopefully this helps people who are just sitting there thinking about buying a house, learn a little bit more about it, understand that, if you have a 580 credit score, there's options. If you have 500, there is, it's very rare, but if you have no down payment, there's options. There's grant programs. There's 100% financing.
You also work with people as far as credit rebuilding, correct?
Yes. Yeah. And that's a huge thing. People, go talk to your lender, get it squared away. We can tell you the steps that you need to do if you do need to get your score up higher.
Yeah.
And, down payment is the biggest thing I see borrowers. That's the biggest thing holding people up. And, I think if you surveyed people, they would say that's their biggest thing holding them back from buying a house. And, there's ways that people don't think about. You can obviously a gift from a family member is one of the more common ones we see for people that don't have it. But you can sell a car. I've had people sell cars, and you have to document it and show the value of the car and sell it. But you can liquidate assets in certain ones, and you have to document everything to do it. But sometimes you got to think think of the different ways that you can come across doing that. And you'd be surprised, not every family's in the position to help, but a lot of times people help do that, especially when you have a chance to communicate with the parents and kind of show them the value of home ownership. And, with the rising rents, which again, when we talk about whether you should buy right now or wait, that's something we can definitely dive into and show why the calculations show buy.
Yeah. Again, I appreciate it. How can people reach out to you? You got an email address?
Yeah. You can reach out to me. Feel free to email me at travis.smith@myccmortgage.com. That's CC is for Cross Country Mortgage. And of course, you can reach out to me via email. Obviously, I'm on all the social medias. Travis Smith, look me up.
There's got to be a ton of Travis.
Yeah, I know. As I started saying that, I was like, oh, wait a minute. Now that I think about that, there's probably 500 of them. I don't have my exact URL to my Facebook or Instagram, but search around for the guy with cross country, and I'm sure you'll figure me out.
Cool. Thanks again, Travis.
Awesome, Dylan. I appreciate it.
Thank you for tuning in to the Real Talk Real Estate PDX podcast. Stay up to date on Portland real estate action by subscribing or follow along on Instagram at Real Talk Real Estate PDX. Any questions or comments about this episode or any real estate matter, feel free to reach me at dylan.pdxrealtor@gmail.com. Thanks again and have a great day.